Speaking of Alternatives with Keshav Rajagopalan, Managing Director, Head of Strategic Capital Group at PGIM. The private equity secondaries market provides critically important liquidity to private equity investments. It can provide an off-ramp to some investors and an on-ramp to others who seek diversified access to maturing private equity assets. Keshav delves into the world of private equity secondaries with Dan Klima, Managing Partner at Montana Capital Partners.
Welcome to Speaking of Alternatives, the podcast where we dig deep into the many layers of the alternatives landscape. Today, I'm excited to be joined by Dan Klima, Managing Partner of Montana Capital Partners, which is the private equity secondaries platform of PGIM. We're here to talk about MCP's annual investor survey, now in its 14th year, and explore through that conversation how LPs are thinking about volatility, liquidity constraints, and a rapidly evolving private equity secondaries landscape. For this survey, more than 20,000 data points were used and around 300 billion of private alternatives are represented from across the globe. So it really is a wide encompassing range of thematically how investors are thinking about this space. And Dan, very excited about this conversation. So thanks for joining me.
Thanks for having me.
To start, I always like to learn a little bit about you. What brought you into the investment space? What brought you to MCP? And what excites you about what you're doing today?
Absolutely. Backing up for a sec, I was always interested in the world of finance, global economies, geopolitics, and that's what I decided to explore while in college. I thought that post-college, I would go into investment banking to really broaden my experience and as a stepping stone into other opportunities. So I joined CSFB in New York in 2004, spent a couple of years there, and I learned about the world of secondary private equity from my associates when I was there. Really a growing but nascent industry at the time. Was lucky enough to get a few interviews and got positioned at a company called Lexington Partners, which is another private equity global platform back in 2006. Spent about 14 years there with the firm, decided to pivot to broaden my skill sets to Lazard Private Capital Advisory, where I was a partner advising on both the sale of fund portfolios and more concentrated GP-led continuation vehicles. It was there over a number of years that I met the senior team and the New York-based team of MCP and really came to appreciate the platform and the individuals here. And about a year and a half ago, I made the very joyous decision to join the platform at MCP as the head of North America to help build the platform here in the United States and to help integrate MCP into PGIM following its acquisition in 2021.
Well, congrats on the recent closing of the fund. Let's get into this conversation a little bit. Before diving into the survey itself, which will have a lot of insights, set the stage for me on what is private equity secondaries. How do investors think about the space? How do you characterize it? Just to set the stage a little bit.
It's really a derivative of the broader private equity sector. If you take a step back and boil it down, all we're doing is providing liquidity for an illiquid asset. And the industry has now bifurcated itself into two broader-based platforms, either what we call the LP-led side, which is initiated by investors or LPs, which typically are sales of fund portfolios. They help investors manage their exposure to underlying alternatives, or what we call the GP-led side of the market, which is when sponsors initiate a sales process to transfer an asset or a number of assets to a special purpose vehicle, which we call continuation vehicles, through an affiliate transfer to help manage their trophy assets and to help provide liquidity to their investors.
In addition to offering greater liquidity for private equity investors who seek an early exit, the secondaries market is an efficient way for new investors to come on board, potentially at a discount at a time when PE fund is maturing and when potentially high returns can be earned.
Now, why do investors like this sector? It's for a number of reasons. First, it provides instant diversification through the look-through of multiple underlying portfolio companies. It provides J-curve mitigation, which is oftentimes caused by management fees and deployment drags in the first several years of a fund's lifespan. It offers liquidity management and better cash-on-cash returns to investors. And Of all the strategies within the broader-based alternatives platforms, I would say it offers the best risk-adjusted returns.
I think that context of a derivative exposure makes sense, right? You've got the GP-led side and the LP-led side, the diversification benefits, the J-curve mitigation. Why is it compelling today? If you were an investor, if you talk to one of your clients, what's the use case today to say now's the time to look at the space?
I would say it's an all-weather strategy. In times of dislocation, we're able to reprice assets through the purchase of fund portfolios at a discount, or we can double down on a sponsor's most highly valued trophy assets through the GP-led markets. And this durability through cycles, this all-weather strategy, is one of the most attractive features of this strategy, which is why I think despite fundraising being down 3 years in a row and having plateaued in 2025, you can see that secondaries remains a bright spot within fundraising. In fact, I believe it was up over 10% last year. So you can see that investors are still voting with their feet to continue to deploy capital into the secondary sector. And it allows us to really target specific assets through those GP-leds and calibrate fund portfolios at scale via the LP-led markets. As I've said before, if you're an investor looking for instant diversification, J-curve mitigation, and a better cash flow profile, meaning shorter duration and higher cash-on-cash returns, those are all advantages of the secondary market.
It can be very compelling. So let's get into the survey a little bit to unpack some of the themes we're hearing from investors out there and how you all are thinking about it. Maybe I'll start with a headline in the survey. So 86% of investors will either maintain or increase their allocation into PE secondaries, with more than 50% of investors feeling no or limited impact from prolonged market volatility. That feels like a major change for the asset class from a few years ago. And you also mentioned a muted fundraising environment. How are we thinking about that? And how are you making sense of that?
I think the markets, as you've seen over the past several years, continues to grow, continues to evolve, and continues to expand. And it's funny, when I started over 20 years ago in secondaries, I thought at the time we were in our early innings. And after 20 years, I still feel that we're in the early innings. The markets, the secondary market, continues to become more specialized. You've seen people focus on GP-leds, people focus on LP-leds, particular sectors. You've seen the bifurcation of strategies in terms of funds being raised around buyouts, middle market buyout, credit, infrastructure, real assets, what have you. And that growth and that specialization has really propelled the market into new highs. You've seen volumes increase to what was probably between $225 and $245 billion of volume last year, depending on what research report you read, which was up from about 160 in 2024. So you're seeing tremendous growth in the market. And this has propelled and supported investors' demand and interest in secondary funds. The consistency of those returns, the risk-adjusted returns, and the durability of those cash flows has allowed investors to continue to invest in this sector. And again, I think our research shows that over 50% of our respondents report no or limited disruption. I think one of the main friction points is slowing distributions. As you may have read, distributions as a percentage of net asset value has declined to the low teens over the past several years. That's probably half of what it was 10 or 15 years ago. But through secondaries, through the repricing of assets, and through that J-curve mitigation, I think our strategy allows investors to have more consistent cash flows and returns. And I think what our investor survey shows is that most investors are still confident that they will achieve their ultimate TVPI underwritten projections, albeit maybe with a slightly lower IRR or DPI.
I guess that kind of comes to your all-weather point that even in times of market volatility, such as what we're experiencing now, the solution you all are providing, whether to an LP or a GP side, is still allowing for then that kind of cash flow profile to your end investor using this asset class in that sort of way.
Exactly. And we like to think of ourselves as being agnostic. Our funds in particular have a balanced approach between the LP-led and GP-led sectors. So we tend to lean in on either of those markets from a very broad perspective. based on where we see the risk-adjusted return angle to be the most attractive at that point in time.
That makes sense. If we go a little deeper into some of the core themes of the survey, what would you say are the biggest tailwinds when you think about the asset class?
Some of the tailwinds in the secondary sector, again, include lower default risk, J-curve mitigation, increased diversification, and again, increased specialization, where managers are focusing on more specific subsectors of the alternatives markets. There's increased interest in the private credit secondaries market as well as other strategies. And we see a 72% rating of investors in favor of that specific private credit secondaries strategy. I think some of the challenges that we've encountered are the bid-ask spread. I think the run-up in valuations have persisted, and there's a slow closing of that gap between what buyers are willing to pay and what sellers are willing to accept. I think LPs are overstretched. We've seen that in a number of surveys that LPs have overcommitted and are overextended in terms of bandwidth, experience, and those tooling constraints hinder more of their active secondary sales.
The private equity secondaries middle market could be seen as a particularly dynamic and fertile area for investors, rife with opportunities for both buyers and sellers.
You mentioned the specialization piece as a follow-up, kind of share more about how you all are thinking about then portfolio positioning. Obviously, you focus on the middle market space. When you think of that specialization theme of what's happening with managers, how are we positioning the MCP approach vis-a-vis some of the specialization then?
Well, we at MCP consider ourselves to be focused and specialized in the lower, mid, and middle market buyout sector. I think what you've seen in the past is that in terms of historical TVPI and DPI, the lower middle market and middle market has outperformed the large buyout sector, but the dispersion of those returns can be quite wide within that middle market sector. And therefore, you need someone like Montana who can navigate the middle market and find those managers and assets that are truly exceptional or first quartile in order to drive those returns. Again, that specialization that we're seeing in the markets is going to drive the distinction between the average secondary manager and the first and second quartile secondary managers.
And we'd like to get some questions from the floor, which is directly from our distribution teams who are talking to clients. What is that sweet spot in the middle markets? Why do you think that's the place to play versus large cap or venture or other kind of sectors?
It's a good question. I think the way we see it is that when you're in the lower middle market or middle market, that's the first instance when you bring in true institutional know-how and capital into a company, and it provides the sponsor or the manager the ability to truly enact change and value creation on a fundamental level in that portfolio company. And not only that, it provides the sponsor with numerous exit opportunities in terms of selling to another sponsor that's maybe further up the value chain, selling to a strategic partner, potentially doing a continuation vehicle exit, which now account for roughly 10% of all private equity exits. So it provides the manager not only a lot of optionality to enact value creation, but also enact monetization, where we feel at the large mega buyout space, your options are a bit more limited in terms of both of those factors. So that's why you see, particularly in the first quartile and second quartile, those lower mid-market and mid-market buyouts sponsors perform quite a bit better than your average mega buyout sponsor.
So talk a little bit more about how investors are looking at some of the advantages on co-investments then through secondaries. How is that different than the primary PE space? How does co-investment work, and how do you all think about that?
Yeah, so I think co-investments offered by secondaries managers specifically are valued for their effectiveness and operational efficiency. I think investors particularly appreciate access to the manager's due diligence, pricing insights, structuring capabilities, rather than viewing those co-investments purely as a return enhancement tool. I believe from my interactions with our investors that co-investments allow our LPs and potential LPs to better understand how we think about due diligence, asset selection, and allows those investors and ourselves and sponsors to form closer relationships.
You mentioned operational efficiencies. Share more about what you mean by that.
It's a good question. In terms of operational efficiency, I believe it offers our investors the ability to access fund portfolios and secondary transactions that are diligent and allows our investors to access fund portfolios and GP-led transactions where we can provide a very deep level of due diligence that they may not be able to access, again, given the fact that, I think a lot of investors are at capacity and overstrained and overexerted at the fundamental level.
Then share a little bit, obviously, co-invest provide ways to put money to work faster and, as you pointed out, more efficiently, perhaps. How are LPs, how are some of our clients reconciling the slower exits and longer return timelines, but with still meeting the expectations for DPI, TVPI? What are those trade-offs? Because you mentioned this as a derivative can give you some more stability of cash flows, but if the overall market is challenged from an exit perspective, how do you balance what they're trying to achieve here?
I think investors today, as opposed to maybe 20 years ago, they see their relationships with someone like a Montana holistically in terms of how can we deploy capital, both from a LP commitment to the fund, but also co-invest alongside that commitment and really manage our cash flows and really maybe double down or increase their exposure to those fund portfolios or secondary opportunities that we bring to them that may provide that near-term cash flow. So oftentimes when you're buying into fund portfolios, as you may know, you're buying into funds that are 4, 5, 6, 7 years into their lifespan. And when you're entering into those LP positions, when you're stepping into the shoes of the prior LP, you're oftentimes the beneficiary of almost instantaneous distributions from that fund portfolio. So it's a way for investors to help manage their duration and cash on cash returns by really leaning into those opportunities that we bring to them that could have higher IRRs or higher cash flow velocity.
Well, very helpful. And thanks for going through the survey. Folks can check it out online on the PGIM website as well, just to read more about it. But 3 things that stood out to me. One is overall, Dan, your framing of the asset class is very helpful. Why are investors looking at this? And the things that I took away is the durability and diversification point. There is an all-weather approach here to private equity exposure. Second, I really found it interesting how you talked about how MCP focuses on that kind of lower middle market or core middle market, and the idea that there's more optionality there for value creation, which then makes the asset class attractive. And third, I think, is really how you as a platform and MCP overall as a platform is thinking about the space where you get GP and LP led. So it also provides different tools then where you're offering solutions to some of our partners, but then from an investor perspective, you're kind of getting diversification and approach as well. So really enjoyed this conversation, and thanks for sharing some perspectives on the survey and the asset class.
Absolutely. Thanks for having me, and thanks for the interest in Montana.
Well, Dan, thanks again for the chat. Really appreciate it. Join us next time where we'll dive into the lower middle market direct lending space with Tas Hassan of Deer Path Capital on Speaking of Alternatives.
Speaking of Alternatives with Keshav Rajagopalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast, The Outthinking Investor, also from PGIM. Past performance is not a guarantee of future results. Views and opinions expressed may not reflect PGIM's and are subject to change. This is not a solicitation. Copyright 2026 PFI and its related entities registered in many jurisdictions worldwide. Please visit the Terms and Conditions page on www.pgim.com. PFI is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom.